$7.5 trillion. That is how much money is traded in the Forex market every single day. Not every month, not every week, every single day. To put that in perspective, the New York Stock Exchange, one of the most famous financial markets in the world, trades around $25 billion a day. The Forex market does 300 times that volume. And yet, most people have never heard of it. Or if they have, they don't really understand what it is, how it works, or how anyone actually makes money from it. In this video, we're going to change that. By the end, you'll understand exactly how the Forex market works, what currency pairs are, how to read them, what a pip is, the different types of pairs you can trade, and something most beginner videos completely skip: the 4 trading sessions, and why they matter more than most traders realize. Let's get into it. Before we do, quick question. Drop it in the comments. Have you ever heard of Forex before this video, or is this completely new to you? I want to know where you're starting from. Forex is short for foreign exchange, and at its core, it is incredibly simple. Forex is the global market where currencies are bought and sold. You've already participated in Forex, you just didn't know it. Every time you travel to another country and exchange your money at the airport, you're doing a form of Forex. You're trading one currency for another at a specific exchange rate. The difference between you at the airport and a Forex trader is that a trader is trying to profit from the changes in those exchange rates rather than just exchanging for convenience. Now, unlike the stock market, which we covered in video 2, the Forex market has no central exchange. There's no single building or organization that controls it. It is a decentralized global network of banks, financial institutions, hedge funds, corporations, governments, and individual retail traders, all trading currencies with each other around the clock. This is why the Forex market is open 24 hours a day, 5 days a week. Because somewhere in the world, a financial center is always open and trading. It only closes over the weekend. And because of this enormous size and constant activity, the Forex market is also the most liquid financial market in the world. Liquidity means you can enter and exit trades quickly, without moving the market against you, something that matters a great deal once you start trading actively. In Forex, you never trade a single currency on its own. You always trade currencies in pairs. This is because when you buy one currency, you have to sell another. The two are always linked together. A currency pair looks like this: EUR/USD. That's the euro against the US dollar, the most traded currency pair in the world. The first currency in the pair is called the base currency. The second is called the quote currency. The price of the pair tells you how much of the quote currency you need to buy 1 unit of the base currency. So if EUR/USD is trading at 1.0850, that means 1 euro costs $1.08. The euro is more valuable than the dollar right now. If that price rises to 1.1000, the euro has gotten stronger. It now costs more dollars to buy 1 euro. If the price falls to 1.0700, the euro has weakened. It costs fewer dollars to buy 1 euro. Now here's the key trading concept to understand. When you buy a currency pair, what traders call going long, you're betting that the base currency will go up in value relative to the quote currency. You want the price to rise. When you sell a currency pair and what traders call going short, you're betting the base currency will weaken. You want the price to fall. That's it. Every Forex trade in the world is one of those two things: long or short, buy or sell, rise or fall. Every currency has a 3-letter code. You'll see these on every platform and broker. USD is the US dollar. EUR is the euro. GBP is the British pound, sometimes called cable by traders. JPY is the Japanese yen. AUD is the Australian dollar. CAD is the Canadian dollar. CHF is the Swiss franc. NZD is the New Zealand dollar, nicknamed the Kiwi. These 8 currencies form the foundation of the Forex market. And the pairs made from them are what most traders, including professionals, focus on. Not all currency pairs are created equal. They're grouped into 3 categories: majors, minors, and exotics. And understanding the difference is important, especially when you're starting out. Major pairs are the most traded currency pairs in the world. They all include the US dollar, because the dollar is the world's reserve currency. It's involved in the vast majority of all global transactions. The most well-known majors are EUR/USD, GBP/USD, USD/JPY, USD/CHF, AUD/USD, USD/CAD, and NZD/USD. For a beginner, Major pairs are where you want to start, and honestly, many experienced traders never leave them. Here's why. Majors have the tightest spreads, they have the highest liquidity, and they have the most data, analysis, and educational content available. When you're learning, you want to trade the market that's easiest to get in and out of with the least friction. Minor pairs, also called cross pairs, don't include the US dollar but still involve major currencies. Examples are EUR/GBP, GBP/JPY, or EUR/JPY. They're still reasonably liquid but have slightly wider spreads than majors. Traders who have a solid grasp of the majors will often expand into minors. Exotic pairs involve one major currency and one currency from a smaller or emerging market economy, like the US dollar paired with the Turkish lira, the South African rand, or the Mexican peso. Exotics can have dramatic price swings, very wide spreads, and lower liquidity. They're generally not recommended for beginners. The bottom line, start with the majors. EUR/USD in particular is the best pair to learn on. It's the most traded, most analyzed, and most written about pair in the entire market. In the stock market, you measure price movements in dollars and cents. In Forex, we measure them in pips. A pip stands for percentage in point. It's the standard unit of measurement for price movement in Forex. And it's one of those terms you'll hear constantly once you start trading. Here's the rule. For most currency pairs, the price is quoted to 4 decimal places. The 4th decimal place, that's 1 pip. So if EUR/USD moves from 1.0850 to 1.0851, that's a move of 1 pip. If it moves from 1.0850 to 1.0950, that's a move of 100 pips. Now, 1 pip on its own isn't a lot. The reason pips matter is what they're worth. And that depends on how large your trade is. As your position size grows, each pip becomes worth more money. We'll cover position sizing and lot sizes in detail in a later video dedicated to risk management. But the core concept to understand right now is simply that pips are how you measure how far a trade has moved in your favor or against you. There's one important exception to the 4 decimal place rule: Japanese yen pairs. Because the yen has a much lower nominal value than most currencies, pairs involving JPY, like USD/JPY or GBP/JPY, are quoted to only 2 decimal places. On these pairs, the 2nd decimal place is the pip. So USD/JPY at 149.52 moving to 149.53. That's 1 pip. Simple as that. If you're serious about trading, you need more than just knowledge. You need the right tools. At the DTCtools.com, we've built 3 professional-grade strategies: CCT, DTC, and DTC Precision Pro, each with its own trading view indicator, MT5 automated bot, and live signals group. Whether you're passing a prop firm challenge, managing a funded account, or trading your own capital, we have a system built specifically for your goal. No guesswork, no emotions, just systematic, rule-based trading, engineered for consistency. Follow us on Telegram, link is in the description, and use code TELEGRAM20 at checkout for 20% off your next order. Visit the DTCtools.com and find the tool that fits your trading journey. The DTC Tools, trade smarter. Now we get to something that most beginner Forex videos skip entirely, and it's one of the most practically useful things you can understand as a trader. We said the Forex market is open 24 hours a day, 5 days a week, but that doesn't mean every hour of the day is the same. Far from it. The Forex market is divided into 4 major trading sessions, each centered around a major financial hub: Sydney, Tokyo, London, and New York. And the activity level, volatility, and trading opportunities are dramatically different across these sessions. The Sydney session is the first to open each week, kicking things off on Monday morning in Australia. It runs roughly from 10 p.m. to 7 a.m. Greenwich Mean Time. This is the quietest session. Volume is low, and price movements tend to be smaller and slower. Most major currency pairs are relatively calm during this window. The Tokyo session, also called the Asian session, runs from roughly midnight to 9 a.m. Greenwich Mean Time. This session brings more activity, particularly on pairs involving the Japanese yen and the Australian dollar. If you're trading AUD/JPY or USD/JPY, the Tokyo session is when those pairs tend to be most active. Then comes the London session, and this is when things get serious. London opens at 8 a.m. Greenwich Mean Time and closes at 5 p.m. Greenwich Mean Time. London is the financial capital of the world for Forex. Roughly 35 to 40% of all global Forex trading takes place during the London session. This is the highest volume, highest liquidity, tightest spread session of the trading day. Price moves are larger, trends are cleaner, and the market is at its most active. The New York session runs from 1 p.m. to 10 p.m. Greenwich Mean Time. And there's an important overlap you need to know about. From 1 p.m. to 5 p.m. Greenwich Mean Time, the London and New York sessions are both open at the same time. This is the London-New York overlap, and it is the single most active period in the entire Forex market. Liquidity is at its peak. Spreads are at their tightest. Price moves are at their largest. If you're a day trader looking for the best conditions, this 4-hour window is where the action is. Why does this matter for you practically? Because not all trading hours are equal. If you're trading EUR/USD at 3 a.m. GMT on a Tuesday, you're trading in the middle of a very quiet Sydney session with minimal volume and choppy, unpredictable price action. The same strategy applied during the London session at 10 a.m. Greenwich Mean Time, with full market participation, will behave very differently. Understanding sessions helps you know when your pairs are most active, when volatility is highest, and when to be in front of your charts versus when to step away. A simple rule for beginners: if you're trading the major pairs, EUR/USD, GBP/USD, the London session and the London-New York overlap are your prime windows. That's when these pairs move the most consistently.
Let's bring everything together with a simple picture of what Forex trading actually looks like in practice. Imagine it's 9:30 a.m. in London. The London session has been open for an hour and a half. You're looking at euro to US dollar, the euro against the US dollar. The price is at 1.14500. You've been watching the chart, and you believe, based on your analysis, that the euro is going to strengthen against the dollar over the next few hours. So you decide to go long. You buy EUR/USD. Within an hour, EUR/USD has moved to 1.14600. That's a move of 10 pips in your favor. You decide to close the trade and take your profit. Depending on the size of your position, those 10 pips could represent a meaningful gain. That's a Forex trade. You identified a potential price movement, bought a currency pair, the price moved in your favor, and you closed the trade for a profit. Of course, the market doesn't always move in your favor. That's precisely why risk management, which we'll cover in depth in video 10, is the most important skill any Forex trader can develop.
Let's recap what you've learned in this video. Forex, foreign exchange, is the world's largest financial market, trading over $7.5 trillion every single day. It's open 24 hours a day, 5 days a week, because financial centers around the world operate in shifts. In Forex, you always trade currencies in pairs. The base currency is the one you're buying or selling. The quote currency is what you're pricing it against. You either go long, expecting the price to rise, or go short, expecting it to fall. Currency pairs are divided into 3 categories: major pairs, which all include the US dollar and are the most liquid; minor pairs, which cross between major currencies without the dollar; and exotic pairs, which involve smaller economies and are riskier for beginners. Price movements in Forex are measured in pips, the 4th decimal place on most pairs, and the 2nd decimal place on Japanese yen pairs. And finally, the Forex market operates in 4 major sessions: Sydney, Tokyo, London, and New York. The London session and the London-New York overlap, from 1 p.m. to 5 p.m. Greenwich Mean Time, is when the market is at its most active and liquid. In the next video, we're shifting to the 3rd major market, crypto. We'll break down what Bitcoin actually is, how crypto exchanges work, what makes crypto different from Forex and stocks, and why the 24/7 highly volatile nature of crypto creates both opportunities and serious risks for traders. Subscribe now so you don't miss it. And if you want to connect with our trading community and get market updates between videos, join our free Telegram channel. The link is in the description below. I'll see you in the next one.